What if the basic support and resistance signs you were taught on day one aren't actually there to protect you?
Oh, man.
Like, what if they are engineered traps specifically designed to steal your money?
It is, it's a super jarring paradigm shift. I mean, if millions of retail traders are reading the exact same textbooks, drawing the exact same trend lines,
Right.
and placing their stop losses in the exact same obvious locations, well, they're voluntarily clustering their capital into these highly predictable pools.
Yeah, they're sending ducks.
Exactly. And in a market driven by algorithmic efficiency, predictability is it's a massive vulnerability.
Well, welcome to the deep dive. Today, consider this your mentorship check-in. We're pulling directly from a stack of Month 4 Inner Circle Trader or ICT Core content transcripts.
Good stuff in there. Really dense, but good.
Yeah, definitely dense. So our mission today is singular. We want to decode exactly how to identify fair value gaps and breaker blocks.
Right, because these are the tools you need to spot those high probability trade entries.
Exactly. So if you're listening, we are going to strip away the noise. We're going to translate all that heavy institutional jargon into plain English.
No PhD required today.
Right, exactly. We're looking at the market not as a random chaotic heartbeat monitor, but as a predatory algorithm.
Predatory is the perfect word for it, honestly, because the market really only moves for one primary reason, and that is to seek liquidity.
Which is a heavy word.
Yeah.
So let's strip the jargon. Liquidity just means what? Resting orders.
Yeah, simply put, it's resting orders. But more specifically, we're talking about the massive clusters of stop-loss orders resting just above old highs, which are buy stops,
Right.
and just below old lows, which we call sell stops.
Okay, let's unpack this. I want to start with the absolute mechanics of how smart money operates, just so no one gets left behind. It's the foundation for literally everything else.
It really is.
So as a day trader, you are taught to buy at support and put your sell stop directly under that support line.
Right.
It makes logical sense for risk management.
Totally. It's day one textbook stuff.
But consider the large financial institutions, right? The smart money. They have these incredibly deep pockets. If they want to execute a massive buy order, they can't just hit the buy button at the current market price.
Oh, no. There simply wouldn't be enough willing sellers at that exact microsecond to fill their massive order.
Right, they'd experience massive slippage.
Exactly. They'd end up driving the price up against themselves before their order was even half filled. So to buy a massive position efficiently, they require an equal and opposite amount of sell pressure.
They need eager sellers.
They need sellers, yeah. So what do? They engineer that sell pressure. They intentionally drive the price down, temporarily breaking below that obvious old low.
The exact spot where everyone's protective sell stops are resting.
You got it.
It's like the second the price drops below that line, it triggers an avalanche. All those retail sell stops are instantly converted into active market sell orders.
Which creates a total flood of sell pressure hitting the market all at once.
Yeah, and to the retail trader, it looks like a breakdown. It looks like the market is totally crashing.
And waiting right there at the bottom of that engineered crash is smart money.
Scooping it all up.
Exactly. They use the panic and they use the automated mechanical sell stops of retail traders to fill their massive institutional buy positions at a wholesale discount.
Wow.
That is the stop hunt. They sweep the liquidity pool, absorb the orders, and having accumulated their massive long position, they just violently reverse the market and send the price higher.
It's such a brutal mechanism when you really look at it. I always think of it like a giant game of capture the flag where the flags are retail stop losses.
Oh, I like that analogy.
Yeah, so smart money, they run across the field, they dip just out of bounds to grab your liquidity,
Yeah.
and then use that influx of capital to just sprint in the complete opposite direction.
Exactly how it works.
But I guess my question is, if smart money is deliberately hunting these stops to build their positions, how do we, as smaller traders, actually spot their footprints on the chart without getting stepped on? Because they can't do this invisibly, right?
No.
They're moving massive volume.
Right. They can't hide it completely.
Yeah.
So if we connect this to the bigger picture, those footprints show up as specific, recognizable shifts in market structure.
Okay.
When smart money manipulates the price to grab that liquidity and then aggressively shifts direction, they leave behind institutional blocks.
The order block.
Yes. The most foundational of these footprints is the order block. To understand the more advanced tracks, like breakers and fair value gaps, we first have to define this core element.
So let's define it. Let's focus specifically on the bullish order block. Because when you're looking at a candlestick chart, an order block isn't just, any random down-closing candle.
Oh, no, not at all. The sources are incredibly specific about this. It is the last down-close candle that occurs right before a significant explosive move upward that breaks a prior high.
So it's all about context.
So the location and the context are everything, yeah. That specific down candle represents the exact moment in time we just talked about. It is the literal footprint of institutional accumulation.
It's the visual record of them pushing the price down one last time, triggering the retail sell stops, absorbing it all, and then rocketing up.
Precisely.
But spotting that candle is just step one.
Right.
Right? The sources outline a pretty crucial risk management metric to figure out if that specific block is actually going to act as support later on.
Yeah, they call it the mean threshold.
A mean threshold. Okay, explain that.
So the mean threshold is a mathematically precise line. You draw it at exactly the 50% midpoint of that down candle's body.
So we ignore the wicks entirely.
Yes, entirely. You measure from the open of the candle body to the close of the body, this 50% mark. It's the absolute line in the sand for a valid setup.
So if the market eventually comes back down to test that bullish order block, the bodies of the future candles should never close below that midpoint.
Never. If it's a highly probable setup, it just won't happen.
I always try to visualize this stuff. I look at it like a heavy-duty compressed spring.
Okay.
Like that final down candle, the order block, represents the moment of maximum compression where smart money loaded the spring with capital.
Right.
So when the price eventually drops back down to touch the top of that candle, it's pressing on that tension. And that tension should repel the price upward.
Exactly. It bounces off.
But if the spring snaps in half, meaning the price drops, and completely closes below that 50% mean threshold, well, the tension is gone. The setup is broken. The algorithm basically abandoned that level.
That's a great way to think about it. And the logic behind that 50% threshold is actually rooted in institutional defense.
What do you mean?
Well, think about it. If smart money truly accumulated a massive multi-million-dollar long position inside that specific candle, they're going to actively defend that price level to protect their investment.
Oh, sure. They don't want their position going negative.
Right. They will inject more capital to keep the price above their average entry. So allowing the price to close below the 50% mark signals they just aren't defending it anymore, which invalidates the whole trade idea.
Okay, that makes total sense.
Yeah.
But the market isn't always kind enough to leave a single clean order block, is it?
Wish. No, it isn't.
Sometimes the footprint is infinitely more complex. Sometimes smart money intentionally builds a sophisticated trap to generate even more liquidity. And this brings us to what might be my favorite concept, the breaker block.
The breaker block. It really is where market structure and trading psychology collide perfectly.
Yes.
It's the visual manifestation of trapped institutional capital. The sequence of how a breaker forms is so critical. Should we walk through the anatomy of a bullish breaker?
Let's do it step by step. So if you're listening, try to picture the chart in your mind. The sequence happens in 4 distinct swings. Step 1. The market is dropping, and it makes a clear low point on the chart.
Right. Then step 2. The price rallies slightly. It bounces off that low to create a distinct short-term high.
It's a standard pullback in a downtrend.
Exactly. This is a normal pullback. But step 3 is where the trap is sprung. The market aggressively drops again, pushing completely past that first low to create a lower low.
And that lower low is the trap, right? It accomplishes the liquidity sweep. It runs the sell stops, resting under that first low we talked about earlier.
Yes. They grab the stops. And then, step 4, the reversal. Suddenly, out of nowhere, the market violently shifts direction. It rockets upward and breaks completely above that short-term high that formed in step 2.
So that violent shift upward confirms the trap.
It does. And that specific short-term high sitting right between the two lows, the up candle that formed that high is your breaker block.
Okay, wait, hold on. I'm looking at this structurally, and I'm seeing a massive flaw, or at least a big question.
Okay, hit me.
If the institutions had to open massive short positions at that middle high just to drive the price down and grab the retail stops at the lower low, what happens when the price rockets back up past that middle high?
They're underwater.
Right. Aren't they wrecking their own short positions? Why would they sabotage their own profit and loss just to grab liquidity at the bottom?
What's fascinating here is the absolute necessity of that temporary loss. Institutions have the deep capital required to, float a losing position temporarily.
Because the payoff at the bottom is worth it.
Exactly. It means securing a much larger, way more profitable long position at that lower low. However, they are highly efficient. They despise taking a loss on those initial short trades.
I mean, nobody likes losing money.
Right. So they have these losing short positions stranded at that short-term high. When the overall market price eventually naturally retraces back down to revisit that specific price level, the breaker block, those institutions aggressively execute buy orders.
Here's where it gets really interesting. It's basically institutional buyer's remorse, but for sellers.
Yeah.
They realize they are caught underwater on those original shorts, and they use the retracement to buy back their short positions at break even. They just want out without taking a loss.
The technical term for this behavior from the source material is mitigation. They are mitigating their drawdown.
Right.
Because these institutions are executing massive buy orders simply to close their shorts at break even, that overwhelming influx of buying pressure turns what used to be a resistance level into a rock-solid floor of support.
So as an independent day trader, your entire entry strategy revolves around riding the coattails of their mitigation.
That's your edge.
You don't try to chase the rocket ship upward when it breaks out. You let it go. You just calmly place a buy order exactly at the top of that breaker block, and you wait.
Because you know exactly why the price is going to bounce there.
You know where the trapped institutional capital is waiting to get out.
Precisely. Now, the precision of a breaker block setup really relies on the aggression of that fourth step, the violent shift upward that breaks the short-term high.
It has to be fast.
Right? Yes. Price rarely moves in a slow, orderly fashion when algorithms are reversing a market like that. And that extreme momentum creates another structural anomaly on the chart, which the sources call a fair value gap, or FVG.
The fair value gap. We hear this term everywhere now. It's basically the byproduct of pure, unadulterated institutional speed, isn't it?
It is a literal vacuum.
No.
When price moves with that much aggression, the algorithms are repricing the asset so fast that they skip over entire price levels.
And the sources define this using a strict three-candle rule, right? Let's visualize that.
Okay, so picture 3 sequential candles in an aggressive upward move. Candle 1 is a standard up candle.
Okay.
Candle 2 is the anomaly. It's a massive long-bodied candle surging higher, showing extreme displacement and speed. And then candle 3 is just another up candle continuing the move.
But the gap itself is found in the wicks, not the bodies.
Yes, exactly. If you look closely at the highest point, the top wick of candle 1, and the absolute lowest point, the bottom wick of candle 3, they do not overlap at all.
Which is weird, because in a normal, balanced market, the wicks of neighboring candles usually overlap, right? It creates an efficient delivery of price.
Right, but here, they don't touch. And because they don't overlap, the massive body of candle 2 is left completely exposed. During the lifespan of that middle candle, only one side of market liquidity was delivered.
The buy side.
Exactly, only buyers. There were 0 sellers able to participate in that specific price range because the algorithm just pushed the price up entirely too fast. It creates a total imbalance.
I always compare this to painting a wall.
Oh, the paint roller analogy, yes.
Right. Imagine you have a roller full of paint, and you swipe it down the drywall entirely too fast.
Yeah.
Because you rushed, you missed spots, you leave this porous, uneven patch where the paint didn't fully cover the texture of the wall.
And the market hates an uneven finish.
Exactly. The market is a highly efficient machine, just like a master painter. It despises an imbalance. It must eventually come back with the roller to fill in that patch.
It has to. The algorithmic nature of the market dictates that price must return to that inefficient area. It has to retrace into the space of that massive second candle to offer trading to the sell side, delivering price to both buyers and sellers evenly.
It's like a literal vacuum pulling the price back in. But the nuance here is crucial. When the price naturally drifts back down into that gap, does it have to fill the entire thing before bouncing? Like, do you put your buy order at the very top of the gap, the middle, or the bottom?
This is where we apply another layer of precision from the sources, a concept called consequent encroachment.
Consequent encroachment. That is a mouthful.
It is, but it's simple. Just like the mean threshold of an order block, consequent encroachment is exactly the 50% midpoint of the fair value gap.
So you just measure the empty space.
Yeah, you measure from the high of candle 1 to the low of candle 3 and find the absolute middle of that empty void. It acts as a gauge for institutional momentum.
So if the market is highly bullish, it might only dip into the very top of the fair value gap, tag it, and explode upward.
Right. But often, it will retrace exactly to the consequent encroachment level. That 50% mark, balance the algorithmic books, and then reverse.
But crucially, If the bodies of the retracing candles begin to close below that 50% mark of a bullish gap,
Then it indicates the buying momentum is severely waning. The algorithms are no longer defending the imbalance.
which opens up a completely different scenario, right? What happens if the market doesn't respect the fair value gap at all? What if the price just smashes straight down through it and closes below it?
Does the setup just vanish?
Yeah, does it?
No, the structure doesn't vanish. It inverts. This is an advanced dynamic called an inversion fair value gap.
Oh, wow. Okay.
Yeah, when a bullish fair value gap is completely violated and price closes below it, the algorithm essentially flips its bias.
Yeah.
That old bullish vacuum, which was supposed to act as support, instantly becomes a bearish vacuum.
So if price rallies back up into that same space later on, it will now act as algorithmic resistance, pushing the price lower.
Exactly. It's a constant dynamic puzzle. A failed support instantly becomes a high probability resistance.
Man, that is fascinating. But
Um,
let's bring this all together.
Yeah, let's ground it.
Knowing the mechanical definitions of a breaker block, the consequent encroachment of a fair value gap, and the stop hunt liquidity sweeps, how do we tie these isolated concepts into a singular, repeatable, daily routine? Like, how do you look at a raw price chart and execute a plan that doesn't cause a panic attack?
Well, it requires a strict mentor-guided blueprint. It really is the sequence of the patient trader.
Okay, lay it out for us.
Step 1, you never buy the initial breakout. When you see a consolidation, you sit on your hands and you wait for the manipulation. You wait for the market to dip below an old low and sweep the sell stops.
You let smart money grab the flag.
Exactly. You let them accumulate their position. Then, step 2, you watch for the aggressive shift in market structure. After the low is swept, you want to see the price explode in the opposite direction.
You're looking for that extreme institutional displacement.
Right, to leave behind a visual footprint. Specifically, a fair value gap, or the smashing of a short-term high to create a breaker block.
And step 3 is where discipline truly separates the professionals from the gamblers.
Oh, absolutely.
You sit on your hands again. You do not chase the green candles.
You let it go without you. You wait for the market to do its housekeeping. You wait for the inevitable retracement back into the vacuum of the fair value gap, or back down to the mitigation zone of the breaker block.
And that's when you calculate your consequent encroachment.
Yes. You observe how the candle bodies react to the 50% levels. That is the moment of execution. You place your entry inside the gap or at the breaker, with your stop loss safely below the lowest point of the trap.
So what does this all mean for the listener? It means your ultimate edge as a day trader isn't having a crystal ball.
Not at all.
Your edge isn't predicting the future or relying on a magical indicator. Your edge is pure, unadulterated discipline. It's the ability to let smart money show their hand first.
You let the institutional algorithms do the heavy lifting of reversing the market.
Right, and then you calmly enter in the vacuums and mitigation zones they leave in their wake.
You know, this raises an important question regarding how retail traders are traditionally taught right from the beginning.
Yeah, it completely flips the script.
We've moved from looking at the market as a chaotic, unpredictable beast to understanding it as a highly mechanical machine. It intentionally hunts liquidity, it traps impatient breakout traders, it mitigates its own losses, and it perfectly balances the vacuums it creates.
It changes everything about how you interact with risk. I mean, when you understand the mechanics of a breaker block, you stop fearing a pullback.
Because a pullback isn't a crash.
Exactly. It's just institutions closing out their underwater shorts at break even. And when you understand a fair value gap, a giant red candle isn't terrifying. It's just the market's paint roller coming back to ensure an efficient finish.
Once you map these structural footprints, the randomness disappears. You begin to read the intent of the algorithm rather than just reacting blindly to the price.
Which brings us right back to our opening thought, and something I want you to seriously mull over before your next trading session.
Oh, the paradigm shift.
Yeah. If the market is a highly efficient machine, specifically programmed to hunt standard retail logic like placing a tight stop loss just beneath a classic support line, or buying a simple trendline breakout,
Think about it.
how much of your current trading strategy is actually just engineering you to become the liquidity for someone else's profitable trade?
It really demands an audit of your own habits. Like, are the lines you draw on your chart genuinely protecting your capital?
Or are they simply gathering you into a highly visible tool, patiently waiting to be swept by an algorithm that desperately needs your sell orders to fuel its buy program?
It is a terrifying but entirely necessary reality to accept.
It really is. So the next time you open your platform and look at that raw, jagged chart, don't look for the breakout. Look for the trap. Keep your discipline. Wait for the institutional footprints, measure your thresholds, and whatever you do, stop being the liquidity.
Great advice.
Until next time.